Okay. So the title of the paper that I'm going to present today is Managerial Performance Incentives and Firm Risk During Economic Expansions and Recessions. This is joint work with Elif Shishli-Chiamara of Brandeis University and Alon Raviv of Bar-Ilan University. And this is actually the idea for this paper germinated when I was, and Alon was visiting Brandeis University a few years ago. This is what happens when you put the offices of a macro finance person right next to a corporate finance person and a corporate theorist. So you blend it all together. What is our research question? Our research question is very basic. We ask, does the macro environment have an impact on how managers respond to the pay for performance incentives provided by the stock-based compensation given to the CEOs? And we study the relationship between performance incentives and firm risk over the two business cycles between 1992 and 2009. And we look at this relationship between executive performance incentives and firm risk and find that the relationship weakens as the macro state deteriorates, and it actually strengthens. So the relationship between pay for performance incentives and firm risk strengthens as the macro state improves. So basically we find a procyclicality in the relationship between pay for performance incentives of CEOs and firm risk. So what is our motivation for this analysis? And this procyclicality that we claim exists. We basically attribute this to the increased employment risk that happens in recessions. And this insight is something that we have borrowed and observed in the labor literature, specifically papers by Farber. This is an MBR working paper that was published in 2011, and this basically finds that earnings losses and re-employment rates are substantially worse for those who lost their jobs in the recent recession than those who were displaced in any earlier period in the last 30 years. And one might think that, okay, this type of effect is there, but it's probably there for the lower income strata. But our analysis of the labor market shows us that this is not exactly true. Top income earners tend to also have experienced significant losses during this period. Davis and von Wachter, this is a Brookings working paper, Brookings Institute working paper, and they find that earnings losses of high tenure employees from displacements that occur in recessions are twice as large for displacements that occur in expansions. And Güvenen, Özkan, and Song has a recent publication in JPE, and they find that there is a significant cyclicality of earnings risk, not just for low-income households and individuals, but also top 1% as well. So with this motivation in mind, we move on to analyze this relationship in a theoretical format and calibrate a model where we consider a firm that is financed by equity and also debt, zero coupon debt, to make things simple. And we assume that the debt matures at time t and have a face value of f. This is basically this classic Merton type setup we have. And we conjecture the executive compensation package has three components, and three components that are sensitive to the value of the firm's assets. And the first one is equity-based compensation, stock-based compensation. And the second component, which has been analyzed, is the loss in managerial wealth due to firm-specific insolvency. And the third component that we are adding into the analysis is the loss in managerial wealth due to a macroeconomic downturn But also, this is a joint event, so it's the financial distress of the firm during a downturn. So ultimately, our analysis is going to be composed of two parts. In the first part, we're going to calculate the equity-based compensation of the CEO, and then we're going to look at what is the optimal level of asset risk targeted by the CEO given the equity-based compensation that he or she has. So, so the first component that I spoke of, the equity-based compensation, includes any compensation component that has positive sensitivity to an increase in the value of the firm's assets, that we denote by V, above the strike price H. This is a target firm value, so to speak. So the payoff from this component, this equity-based component, is going to be alpha % of the maximum of the difference between the firm value and this strike price, or the target firm value, divided by that target value, or 0. And for all purposes, notice alpha is going to be actually mapped onto our pay for performance incentive, but we'll get to that later. So alpha here captures the sensitivity of the CEO's wealth to an increase in the value of the firm's asset above this threshold strike price, or threshold firm value. So the second component of the CEO's compensation, or CEO's wealth, is going to depend on the loss due to firm-specific insolvency. So CEO wealth has a positive sensitivity to a decrease in the value of firm's asset, VT, below the face value of its debt, denoted by F. And you might wonder, okay, what kind of loss are we talking about? This is firm-specific insolvency that we're, imagining. So the CEO can lose his or her unsecured defined benefit pension, plan, or he or she might lose significant reputation due to this type of firm-specific insolvency. And the way, we look at the payoff from this particular component at maturity is basically, the difference between the face value of the debt and the firm value, falling below that threshold, basically. So the beta here is going to capture the change in the CEO's wealth for a given percentage change in firm's value below the face value of the debt. So the third component that we are considering in the CEO's wealth is the additional loss in value that the executive compensation of an executive compensation is going to incur because the firm is going to become insolvent during a macro downturn. So how do we think about this type of an event? And this type of an event has been analyzed in, the previous literature. For instance, Alon and Elif looked at this in the banking sector before. And basically the idea here, and there are some empirical studies that found this type of loss due to systemic crisis and the joint event of firm insolvency. So the way we look at the payoff in the loss due to systemic crisis is that we are considering the joint event. So we are looking at the maximum of the face value of the debt and the value of the firm falling below it, and also the joint event happening when you dip into the recession, and the K is going to be the threshold for systemic crisis. This is an index that we use, and I represents the value of the economic index at maturity. So when we fall below this particular threshold, we're in recession or economic contraction, and hence we incur this loss during the systemic crisis. And again, the idea behind, the motivation behind this specific firm insolvency in the event of an economic downturn comes from the fact that it will be more difficult for the CEO to find employment or re-employment, or even if he or she does, it will probably be at conditions and terms that are inferior to a pre-recession event. So what do we do next? We add these, oh, by the way, so the gamma here then is going to represent the sensitivity of the CEO wealth to the joint event of a decrease in the firm value below the face value of the debt, basically, and a recession. So what do? We add all these components up and calculate the present value of the executive's position, which is represented by this equation. As you can see, the first component, we can consider it as a call option. And the second component, which is the firm-specific insolvency, is going to be a put option. And the third component, which is considering this joint event of a macro downturn plus the firm-specific insolvency, is going to involve a two-asset correlation put option, which, by the way, is not that easy to find in the market. You can't easily insure against this type of thing. You could insure against perhaps a market going down, but this type of two-asset correlation put option is not, at least as far as I know, is not very readily available as an insurance. So what do we do with all this theoretical background? We use this as an example, and based on the parameters that we take from the literature, we calibrate a model, and find this basic relationship. That is summarized by this figure. As you can see on the figure, we have the performance incentive on the x-axis and the asset risk on the y-axis. And the main takeaway from this figure is that a given increase in alpha, the pay for performance incentive, results in a smaller increase in the optimal risk targeted by the CEO when the economy is in recession. So you can see that this the purple line is when the economy is performing above the threshold, and as the macro state worsens, you can see that the effect, the given increase in the pay for performance, actually leads to a smaller increase in firm risk. So with this theoretical framework in mind, we conduct an empirical analysis, again, to restate the hypothesis. We conjecture that the relationship between executive performance incentives and the firm risk weakens as the macro state worsens, or vice versa, basically. So what kind of a sample do we have? We have data from EquityComp on executive compensation, and this includes the S&P 1,500 firms, excluding the financials and the utility firms, the regulated ones, and our sample spans the 1992 to 2009 period. There was a change in EquityComp, the way they report the executive compensation components, so we adjust for that using or based on what the literature does, and basically calls Naveen et al. Is a JFE paper that we follow closely in that regard in dealing with these reporting changes. And so the stock returns basically come from CRISP, the stock returns as well as the market returns that we're using. We measure the total risk. So our left-hand side variable, the dependent variable, is going to be the logarithm of the variance of daily returns. And we also calculate idiosyncratic risk or unsystematic risk, which is the logarithm of the annualized variance of the residuals from the market model, basically. And the financial variables come from CompuStat. So our summary statistics, basically, the focus variable is delta, as you can see. So delta basically captures the sensitivity of the CEO's wealth to 1% increase in stock price. And this is the pay for performance incentive that we've been talking about. And that nicely maps to alpha, which was depicted in the calibration example that I have shown you. And you can see that there is a, we report the different percentiles in the distribution of executive compensation components. Again, we have Vega. Vega is the risk incentive. You probably know this is the sensitivity of the CEO's wealth to 1% increase in the standard deviation of the stock return, basically. So, what is our analysis? What is the format of our empirical analysis? We have, again, firm risk on the left-hand side, and then delta is our main focus variable. Aside from the main focus variable, we have some controls, which we directly take from Coles, Nevin et al., which have a shorter sample analysis than we do. So we include a lag of these compensation variables, thinking of endogeneity issues, which we will address separately. We also have a lagged cash that the CEO's compensation package includes. His tenure, the sales, the market-to-book ratio, R&D expenditures, CapEx, and the leverage of the firm as control variables. And these are standard controls in the literature, thinking that different companies with different R&D profiles will also have different risk profiles. So there's an argument that these are controls, basically. And depending on the specification, we also control for market volatility, lagged firm volatility, fixed effects, firm fixed effects, employment spells, and things like year fixed effects that I'm going to mention later in the actual empirical results. And so the macro indicators we include in our analysis are MBR business cycle dates, and also announcement values for selected macro variables like non-farm payroll, or changes in non-farm payroll, employment, GDP growth rates, and things like that. So, what do we find? First of all, we took a look at the relationship between performance incentives and firm risk. And as you can see here, we have different versions of the same regression. I don't report the controls here, but the idea is that we have industry fixed effects, firm fixed effects, and firm manager fixed effects, thinking that these spells could also be generating some variation in the analysis. And what do we find? We basically find that the log delta, the lag value of the pay for performance incentive, is positive, as the literature suggests. And we actually make sure that our results align with Coles, Nevin et al. That's why we have this 1993 to 2002 sample, which they focus on, basically. And what we find is that increasing the managerial performance incentives from its 25th percentile, which corresponds to roughly $50,000 in terms of delta, to its 75th percentile, which corresponds to about $400,000, implies about 15% increase in firm risk. So this is the economic significance of the coefficient that you are seeing up there. So, but we want to, okay, we know, okay, we matched the previous results, okay, our summary statistics match with the previous analysis. So let's, extend the analysis further and look at how macro conditions affect this relationship that has been documented in the literature. So we look at this relationship under different macro conditions. We first use, in order to capture different macro conditions, we use MBR recession and expansion dates, so it's simple dummy variable. Then we consider, again, as I said, GDP growth rate announcements. These are all unrevised announcements. We actually specifically made sure that these are unrevised because this is in the information set of the CEO when he or she makes a decision. We include growth in sales, personal consumption expenditures, and things like that. So what do we hypothesize here? Again, we say that there's a positive relationship between firm risk and performance incentives in relatively lower economic states during, during economic downturns. So what do we conjecture here? We conjecture that when we interact the pay for performance incentive with macro state, we should be finding a result that is negative. So I highlighted the wrong one, by the way. I was highlighting vega, which is wrong, the interaction with vega. So what do we find here in the interaction term, which is the key coefficient that we're looking at? Here we find that a 1% increase in delta is associated with about 2.3 basis points reduction in firm risk. Okay, if the firm faces a recession for at least 90 days over its fiscal year. Okay, and so you might be wondering, okay, but what's happening to log delta that you have by itself, up at above? Actually, if we look at the economic significance of what we have found, we find that the impact of an increase in the CEO's delta from its 25th percentile value to its 75th percentile value, we find that this increase is associated with a 16% increase in firm risk during expansion periods, which is that first term up at the right-hand side top row. But considering the interaction term, we find that the same increase in delta leads to virtually no increase in firm risk in recession. So this is the main takeaway from this this regression analysis. And basically, no matter what kind of spell effect you use, firm effect, industry effect, this result is there. We also thought maybe the number of days the firm faces a recession within a fiscal year might also be important. So we, instead of using just a recession dummy, we use the number of days, number of recession days within a fiscal year as another measure, and basically the results are the same. So then we thought, okay, these dummies are nice and everything, and these MBR dates are good, but what if you want to capture the severity of the crisis? So for that, we need a continuous variable, and we include the GDP growth rate. And as you can see, these GDP growth rates are reported for fiscal years. So these are the median. So it's reported 4 times a year. So we calculate the median of these things in each fiscal year. And when we interact our pay for performance variable with the GDP growth measure that we have, what we find is, again, is in line with our hypothesis, which basically suggests that, which is positive, which basically means that when the economy is at its highest state, okay, then what happens is that an increase in performance incentives from its 25th to 75th percentile value is associated with a 40% increase in firm risk. When the economy is at its lowest state, then the same increase in performance incentives is going to result in 30% decline in firm risk. So these are pretty significant results, or economic significances that we're talking about. Of course, the big thing. So I'm not going to go over the non-farm payroll because these are basically validating the previous results. But we also conduct this analysis using idiosyncratic risk, and the idea here is that you might be thinking naturally that macro state could be associated with the systematic component of the total risk, and therefore We replicated the analysis using idiosyncratic risk, which are the residuals that we get from the market model, and basically we find the same conclusion. Of course, whenever you talk about executive compensation and its relationship with outcomes, firm outcomes, of course the big elephant in the room is endogeneity, and we follow the leaders in this literature, which are Armstrong and Vashishta, and we use their techniques, the instrumental variable technique, to address this problem. And we use cash over sales, tax loss carry forward variable, the return on asset, and stock return as instruments. In our IV approach, we use a two-stage least squares method, and we test the validity of these instruments using Hansen's test of over-identifying restrictions. And so basic concern of, obviously, why are we using this? Because our concern is that, okay, compensation or lacked compensation, yes, it's affecting risk, but it's also possible that macro environment, risk environment affects compensation itself as well. So, we conducted, this is the, why we use this. This is the, I take it from Armstrong and Vashishta, why these instruments are valid and things like that. But our results, the ones that are based on the two-stage least square IV approach, again confirm the previous finding that there seems to be a relationship between firm risk and pay for performance that is state dependent. And hence, I think I'm going to conclude by saying that we studied the relationship between performance incentives and firm risk over the last two business cycles, the biggest two, let's say, between 1992 and 2009. And we find that the relationship between executive performance incentives and firm risk is procyclical. It weakens as the macro state deteriorates. It improves, strengthens as the macro state improves. Thank you very much, and I'll be happy to take any questions.